Good morning. You're watching The Market right here on 18 Hour with me, Aisha Faridi, Avan Dabash with me. And what a comeback actually for the Nifty. We shot up a good 100 points and made a recovery. Finally made it back to that 19,600 print, at least on the Nifty futures. And we also have seen a sharp recovery from the recent lows. The Nifty alone has seen a recovery of about 350 points from the recent lows. Having said that, the FI selling has only intensified. We've seen over 8,000 crore rupees of selling coming in over the last 3 trading sessions. DIIs though, they've snapped the 3-week buying streak as well, and they too were sellers yesterday. So good 2% recovery nonetheless from the recent lows in the index. And for the Nifty Bank as well, we've seen a recovery of over 400 points coming in. So one would ask, what stocks are the ones which are actually leading the recovery? Well, surprise, surprise, it's actually HDFC Bank. At least that was the case in trade yesterday too, when HDFC Bank at one point in time was the biggest gainer on the Nifty, and Infosys. So, you know, whatever the concerns around IT may be, you have been seeing buying coming in on in IT, in the entire IT pack, and Infy actually has been leading the recovery. Not just that, you've got the likes of HCL Technologies, Coal India, Tata Steel, Bharti, NTPC. They're the ones which have actually been showcasing the big moves and the big recovery as well that we've been seeing. Having said that, Aman, this morning the global handover is once again not impressive, be it US or for that matter how Asia as well is trading.
Absolutely, and you can blame it on some of those tech stocks as well. They've added a lot of pressure, and that really weighed down on the Nasdaq, which ended lower by about 1% or so. So the likes of Nvidia, Apple, etc., they were all under acute pressure. And then, of course, you had a cut coming in on the frontline indices as well. Remember the Fed interest rate policy, where the policymakers will enact another one this year, that continues to remain on the minds of investors. And it seems like Asia is piggybacking on that same momentum. So for the most part, it's lower this morning. And those are some of the other macro parameters with respect to the bond yields quoting at about 4.2% and the volatility index in the US at about 14.4. The Chinese imports and exports for August, they're forecasted to fall about 9.2% and 9% on a year-on-year perspective. So for all the global handover, that's looking weak. But let's also keep the spotlight then on some of the kind of outperformance that we've been seeing in the markets. And in particular, talk a little bit about the entire IT sector as well as the metal sector. Now, although there has been an underperformance within, an outperformance is what we've seen within the IT space, that is really reflecting a solid 3.9%. And this is a move that we've mapped in the last 5 days or so for the Nifty IT index. And take a look what's at the top spot. It's metals that has seen a nice sectoral move on the upside. So names like NMDC have done pretty well. You've got an APL Apollo Tubes, Jindal Stainless as well as Nalco. They have held out within the entire metals basket. IT, as we flagged off as well, and performance coming in from a combination of mid as well as small caps, so the likes of a Persistent, Coforge and Wipro, L&T Tech, those have been at the forefront. And in comparison, the Nifty Bank Index has declined about 0.5%. Let me welcome on board Nikunj Dalmia as well, who's joining in. And Nikunj,
I'm always part of the fridge, just I'm running late today.
Just running late, so let me welcome you then and talk a little bit about the trade setup, the kind of cues that we've witnessed, the outperformance within IT and metals for the last.
I was reading on power stocks, and I just lost track of time. Sometimes you just want to understand the sector.
It's intriguing, the sector.
It's very interesting. See, the sector where you cannot imagine that suddenly because of one rainfall, I never thought power demand would come back.
Yeah.
I mean,
it was such an ignored sector as a whole. Also.
It is the sector which was used to be called the ugly duckling sector. Nobody liked it, nobody owned it. But when I was looking at data and brokerage reports in the morning, the gap between the demand and the production right now is at a peak. And we've never seen this kind of a situation, at least in India. Or I should start saying Bharat now.
Bharat.
But okay, back to markets. Back to Indian markets.
Yes.
I think that, see, what can you make on the trend, what we've seen in last couple of days? It is simple that the bias suddenly from the drift lower has become a positive bias. And that has happened at a time when Bank Nifty has not chipped in. Global markets have been slightly puffy-duffy. Not that markets have taken a giant leap forward, but from a situation of one step back, one step forward, one step forward, one step back, it seems to be slightly different, which is now you're taking 2 steps forward and 1 step back. Now what it means is that if you get little bit of global push, little bit of global, little bit of support from liquidity, the market, can it really go and retest the previous zone of resistance? And that frankly cannot be ruled out. While we may continue to raise the red flag when it comes to individual stocks in the small and the mid-cap index, the market direction in this week, and especially in last 3 days, is clearly telling you that the bearish narrative is not making money. Even best of the bulls are surprised with the market momentum, but the market is in no mood to relent, and that is what we must embrace, and that is what we need to bring, that is what you need to bring out. For me, a total market would be when banks chip in. I think banks are getting ready they're getting ready to come out from their, I'm not use the word, but they're ready to come back from their quarantine. Yeah. I think it's been a long quarantine.
Hibernation,
yeah.
Let's say that.
So they are ready to come out from that. And that I think really would be the final hurrah, so to speak. So I don't think for the year the final hurrah in large cap stocks is done. This week there is more positive than negative. The global cues exactly are not strong and supportive, but right now that's not having a rub-off effect.
Yeah. But the question, of course, is then where are the shorts in the market, right? Given the recovery that you've seen from the recent lows, which on the index, like I mentioned, has been a good 350 points. Yesterday as well, you saw, a good 100-point recovery coming in from the lows of the day. And it's names like PNB, ICICI Bank, Axis Bank, and going down the barrel, it's a Shriram Finance, Apollo Tyres, Dixon Technologies, L&T Tech, etc.
So logically, I think banks should see a bout of short covering if the market momentum continue, because you cannot have like a market moving higher and banks not chipping in. Bank by force, the banking bears by force, they would be forced to cover their short positions. That's how index always has moved in the past. The cause for underperformance, I think, for banks are two. One, ownership. Everybody owns it, everybody likes it. Whatever could go right has gone wrong for banks. Now that is not the situation. Looking at the data on inflation, looking at the data what is coming on the global front, the fact where the dollar index is, how the currency is moved, there is a bit of a macro ripple. So there is suddenly a fly in the ointment, which is inflation. And the dynamic assumptions for the second half of this year now are changed. But I still feel that retail facing franchise will outperform. The festival season indications are not looking bad at all. So my sense is that banks are getting ready. You may see a bout of short covering there. Valuations are not looking all that stretched, and what had become like an over-owned, over-discussed, over-loved, over-adored sector, I guess some degree of semblance there has also come back.
Okay, Nikunj, let's talk about what kept you out in the newsroom for quite some time. You were talking about those interesting takeaways on the entire power space. So if you'd just like to revisit that, talking about the kind of peak demand that we're seeing in August.
Okay, so let's simplify it for our viewers. One is the impact, and second is individual stocks. What has happened is, because August was a very dry month this time because of delayed monsoon, and the air conditioning penetration, our comfort which we require in terms of electricity demand, all that is increasing. As a result, in the month of August, the electricity demand has shot up, and there seems to be a mismatch in what the total installed capacity is versus what the sudden demand is. Now the sudden demand could be erratic, and that may not sustain. And now that things are normalizing on the weather front, the demand will come down. But meanwhile, when you see such a large uptick in demand, what happens? Indian power sector, Avan and Aisha, I'm going to try and simplify it for our viewers, hope I'm able to do that. You have utilities, NTPC, Tata Power, Adani, they generate power, they're power utilities. They sell by two routes. One is PPP, which is that you've entered into a long-term agreement with the buyer, and that is a fixed contract for many years. And 75 to 80% of the broad capacity in India is locked in that. Remaining is what is called as you can sell in the open market. That is what you use, that is called as merchant power. Now the demand has gone higher. You cannot change the price at which long-term contracts have done, but you will definitely get an advantage in terms of merchant power pricing. So companies which have a high exposure to merchant power pricing are the ones they will hit a jackpot. Why will they hit a jackpot? Because your realizations will just go multifold. Your cost of production is same, your realizations they go higher. What happens? You make more money. So the theme to buy, I think for next couple of days would be companies which have a high exposure to merchant power. And I think that is a theme which I think could be a warm theme, could be a charged up theme. Some stocks have run up, but looking at the way our trend is moving, I think we are in for a bumper quarter for companies which have high exposure to merchant power.
Yeah, in fact, staying with the power sector, sources are telling your channel that the Power Ministry has actually asked states and discoms to take immediate steps to meet unprecedented power demand as well. My colleague Prakash Priyadarshi joins in with more details. Prakash, tell us what your sources are telling you.
The Power Ministry has asked all states and discoms to take necessary steps in order to meet unprecedented power demand in the country. As per the Power Ministry's data, power demand has touched all-time high of 241 gigawatt during first week of September. In fact, it has grown by 23% during month of August, which is one of the highest in the world. But the big concern for the government at this point of time is that some states are not able to supply sufficient power to the consumer. In fact, we are witnessing power shortage in several areas, especially during night. Power shortage has reached to 10,000 megawatt during night, which is a big concern for the government at this point of time. Power Ministry is also saying that below normal monsoon has led to high power demand, and depletion in reservoir levels is something which is a big worry for the government, as it is not able to generate sufficient hydropower in order to make a balance. Power Ministry is also expecting to have higher power demand going forward. Taking all into consideration, Power Ministry has instructed all states to make necessary arrangements. In fact, it has already taken several emergency measures. All power generation companies have been instructed to import at least 6% coal for blending purpose. All gas-based power plants will have to be operated with immediate effect. In addition to that, power will be sold through power exchanges in a case where states does not purchase power despite having power purchase agreement. Apart from that, states have been told to shift agriculture load on solar power. Meanwhile, Power Ministry has approached Ministry of Coal and Railways to speed up additional coal supply to the thermal power plants. But it is interesting to note that Power Ministry has maintained that there is sufficient coal stock available in the country to meet any power demand. But the Power Ministry data is telling something different. But the fact is that we have huge power demand in the country and power shortage as well during non-solar hour.
All right, let's move on then away from the power sector and put the spotlight on the global commentary this morning. We've got Vinny here to take us through that. Morning, Vinny.
Good morning, Aman, and let's talk about the important commentaries that have come in. When you look at it, the first one is coming from Mohammad Al-Arian. Now, he's talking about a couple of things. First one is in terms of the US bond yields. What he's saying is that, this is the third straight day that we saw an increase coming in the US bond yields, and he was not expecting that given the jobs data that came out from the US markets on a Friday. But this is mainly due to the supply of bonds, that is their heavy supply of bonds, then obviously investments in great corporates, strong economic data, and of course higher oil prices is keeping these gains coming in and higher bond yields continuing maybe for some time as well. Other than that, he's highlighting about the Fed rate hike. What he believes is that the Fed maybe possibly could take a rate hike this month as well, but they may not take a rate hike this month as well. But we could see that they would keep the door open maybe for a possible rate hike coming and going forward. There is a possibility they could take a rate hike, but this month maybe they could take a pause coming in. The next commentary we have is coming in from Peter Schiff, who's highlighting in terms of the CPI data, and given the current scenario in terms of the strategic petroleum reserves, which is at the lowest level and all-time low level, as well as oil prices are rising. Now, because of that, he believes that the CPI data in the US could see a surge as well. The other commentary that we have is coming in from ECB's Casimir, and who's highlighting in terms of overall the interest rate hikes by the European Central Bank next week. He believes that perhaps that is a possibility of an interest rate hike. Now, he's given two options that could happen for the ECB, because they have to take a rate hike given that the inflation target is at 2%, and currently they're much above the target as well. So they have to take a rate hike, whether they take it either in the month of September or maybe push it over to something like an October or December. Those are the only two possibilities they have of taking a 25 basis point hike. But that is something that they have to take either now or maybe a bit later as well. Lastly, we have commentary coming in from Bank of England's Bailey, and who's highlighting also in terms of the interest rate hikes for Bank of England. They're saying is the end is much nearer than we are expecting, and that is a factor that he's keeping an eye out on in terms of the interest rate hikes.
Okay, let's bring on board our chartists and figure out. Vinny, thanks for highlighting all the global commentary this morning as to what the trade setup is looking like. Kunal and Naresh join in as always. Kunal, hi, morning. Let me start off with you. A good 100-point recovery actually from the session lows. We've made it to 19,650 now in the futures. Will the recovery stay put? Because the global cues are not supportive.
So the only good sign which has changed for the index in last 2 days, specifically yesterday, was large caps making a comeback. So, for example, HDFC Bank was almost at a 10-day, 12-day swing high. The volumes were at I think a 4-day high for the futures for HDFC Bank. There was a slight drop in the open interest for many of the other large cap names, which indicates that there could be a round of short covering which is started off into these large cap stocks. The index futures in the last 4 days and 4 days to the start of the fresh expiry of the September series has seen a incremental drop. So I think it's almost a 15% drop in the open interest for the bank Nifty and a cumulative 10% odd for the Nifty futures, 7% to 10% odd on the Nifty futures. So that also indicates that there is a round of short covering going across the index futures. And then we look out for the key supports that we've been highlighting 90,300 as a broad support for the index over the very short term. So looking at that, I would believe that the recovery could be sustainable because it's a round of short covering. Now, the two important factors is that the Nifty's come back above the 50-day moving average as well as managed to break past about the 90,600 mark. Both of them are very crucial parameters in terms of technicals, and if we sustain those levels of 19,650 DMA, even for the next couple of days, even with a marginal kind of an uptick on the index, we could be expecting the Nifty to come back towards the previous highs of 9,900 plus.
All right, let's get in Naresh's take as well. And Naresh, can't help but take cognizance of the fact that the IT index has done pretty splendidly in these last 5 days, and it's led by large and mid caps across the board. What's your take on where the IT index is headed?
So on the IT index, the problem is we are not seeing the larger names do well. So the first one is Infosys and it's TCS, which are not doing the breakout moves. What we are seeing is the side counters doing better, the lower weight counters doing well. But it is very close to almost a 10 to 12 month high on the Nifty IT index. So positive on the index, but do not expect a blowout move. So it's a buy on dips, which is where you take 2-3 stocks which look interesting. First is HCL Tech, which has given a breakout and has shown leadership. Second is a buy on Wipro, which looks interesting just because it has corrected the most in the larger names. But the rest of the names have done better, the smaller names, the mid-cap names. And over there, something like a Persistence has already moved up quite a bit. So I would be watching out for LTI Mindtree. So one has to be selective in the IT pack as of now.
Okay, get selective within the IT pack. Let's talk individual stocks then. Naresh, what's on your list?
So looking at large caps again, first is a buy on ICICI Bank, a trade here which is with a strict stop loss at 948 and a bounce back target of 1000. It is at the lower end of the trading range. So more like a defensive bet with a very strict stop loss. Second is another defensive bet, a buy on Power Grid, which has been getting tighter into the range of 242 to 255. If it sustains 255, 257 could be making a new all-time high, and the whole power space is doing well. This is the one which has been a laggard, a stop loss at 245 and a target price of 280.
What's on Kunal's radar? Kunal?
So two buy calls. CESC is the first stock which I would suggest as a buy, trading at 90 plus levels. Good momentum which was seen spotted yesterday for the stock. Expecting a targets of 104 on the upside, stop loss at 85. And DMart is something which I would recommend as a buy, coming back towards a 10-day or a 12-day swing high, almost like a V-shaped recovery for the stock in the last 10-12 days. So would suggest a buy with a target of 4,000, stop loss at 36.95.
Okay, and let's address all the other stocks that you need to keep on your radar. Anisha joins in for that. And Anisha, Tata Consumer, thank God they clarified because that stock ran up 4% or I think over 4%, right, during closing?
Yes, when we were anchoring last afternoon, we did see that stock was rising 4% and the company has gone ahead and denied the report. But I'm not sure whether the street is believing that or not because there was a denial in place earlier as well from the Nagpur unit of Haldiram's that we had got exclusively that they had denied that there is no talk of stake sale. But now Tata Consumers, yes, has officially said
that they are not looking at buying any stake in Haldiram's for now. Having said that, what reports were suggesting, and I'll just quickly reiterate what the story was, that they're looking at actually buying 51% stake in Haldiram. The valuation they were talking about was around $10 billion, and we spoke with analysts as well. They were seeing it as a positive development given the kind of brand that Haldiram's has. And it's no secret that Tata Consumer is going very aggressive with respect to its expansion plan. Whether, Nikunj, it was the talk of buying out Bisleri or those ching sauces, etc. It's pretty much on record that they are looking at expanding their product portfolio.
So Nisha, this Haldiram acquisition or Haldiram stake sale has been in works for years now. Every time, the news surfaces up and then the denial is immediately followed with that. So yes, you do get a sense that ultimately the franchise value from the current promoters of Haldiram, they want to unlock it. But Haldiram is an asset that it's going to really find somebody large to really consider and to put that kind of an capital on the place. Just think from Tata Consumer standpoint. They've just, in a sense, worked on improving the return ratios. They've been very careful in where they want to expand, how they want to expand. They've had a legacy issue, which is the ROS and the return ratios were not at par with what the other FMCG companies have. And they've really worked on that by launching, innovating, and by creating new supply chains. Now, Haldiram acquisition could be valued anywhere between $8 to $10 billion in terms of enterprise value. If Tatas are looking at buying 51% stake, we are looking at a commitment of about $3 to $4 billion. And that is something which may not be a very, that is something I don't think is going to be very easy for anybody to consider, considering the kind of path what Tata Consumer has followed in terms of consolidation. But yes, you are absolutely right. When you speak to the company on the record, off the record, you do get a sense that they want to expand and they're open to inorganic acquisition. But when it comes to Haldiram, it will be a tough acquisition. And B, if they go ahead and acquire it, it will really have an impact on the balance sheet and the strength of the balance sheet and the return ratios in the near term. But right now, what do we have? We have an absolute denial from Tata Consumer and from Haldiram Nagpur and from Haldiram, I think the Delhi franchise, that it's all smoke, no fire.
I was just going to say, but there is no smoke without fire, so we'll have to see whether something really emerges on that front. But as of now, that's the stance from the companies. Moving on then, let's discuss electronic manufacturers, and CLSA has come out with their view. They're talking about a lot of key triggers down the line.
Oh, well, yes, and it's very interesting that on the same day you have, of course, the initiation coming in from CLSA with the outperform rating. And on the other hand, you have Kotak, which is downgraded Dixon Tech, saying that the run-up has been quite sharp. But yes, this is something that we have been highlighting, the overall manufacturing theme that we are seeing in India. And there are a lot of levers for it, right from the domestic consumption, which is going up, to the fact that India is becoming quite a bit of export hub, and the increased ordering that we are seeing from across the globe with that China Plus One strategy working out. What CLSA is talking about is the fact that India has three strong USPs. One is the fact that our client relations have been good, and that is something that we can deepen going forward. Secondly, they're talking about the companies who can scale up, because that's the big trigger that they're watching out for. And then, of course, backward integration, etc. is something that one needs to watch out for. On all of these three parameters, they believe that Dixon, Keynes, as well as Amber Enterprises, they're all fairly poised. Amber Enterprises, they believe, is also fair play in terms of the AC, penetration increasing in India, because almost 70 to 80% of the business for Amber Enterprises comes in from room air conditioners. So that's something to watch out for. For Dixon Tech, of course, mobile, that's the big, trigger point. And for Keynes, the entire laptop, import ban and the other small equipment manufacturing that we're seeing in the country. So there are a lot of levers available. But Nikunj, of course, the million-dollar question is it priced in with the kind of run-up we have seen?
Anisha, this is like a sunrise sector, and I'm just going to repeat what I think Manish Chokhani shared with us. He said when Maruti came to India, the entire ecosystem of cars got created. When G came to India, IT services took a birth, and Apple comes to India, of course the ecosystem will change. So there is definitely a degree of respectability when it comes to buying electronics from India. And there is a government push. And I think the push and the policy and the import guard which is now coming in, I think the big picture is very strong. And this really could be a multi-year trend. Within that multi-year trend, you will have to understand that which end of the market you really want to bet on. If you want to go for scale, size, then it is going to be Amber and Dixon. But again, those businesses do not have the best margins because they are ultimately assemblers. Then you move up the value chain and you look at Sharma SGX, and then you throw in Keynes, and you would say that, okay, if the operating leverage kicks in, these stocks which are looking expensive right now, suddenly they will start looking very, very different. I think this is a multi-year theme. These stocks are, yes, they are stretched because of the recent run-up, but I think for a long-haul investor, it is important to keep your faith, because when a sector, in a sense, is just going to be, when a sunrise sector is going to take a birth, the valuations initially would be strong. But eventually when the sector picks up, operating leverage benefit, ratio benefit, and all the other benefits would kick in. So today what is looking expensive, 3 years from now, trust me, it will look like a great opportunity, or if you've not bought, a great missed opportunity.
Okay, that's the view coming in on the two stocks to keep on your radar, or the sectors as well to keep in the spotlight. More big voices as well then from the sidelines of the Global Fintech Fest, and my colleague Ankur Mishra caught up with Axis Bank's MD and CEO Amitabh Chaudhary talking a little bit about the Max Life deal. Let's listen into that exclusive conversation.
Almost every product which RBI is launching from the Innovation Hub, I think Axis Bank is one of the banks which is part of that exercise. So we have launched Kisan Credit Card, which you saw. We have launched a similar platform for MSMEs. We are launching UPI on credit. And I think you will see more and more of these products being launched by Axis, because we do want to be at the forefront of this. We fully realize and appreciate that the market might not be ready. We fully realize and appreciate that in some cases we still need some parts of the ecosystem to come together. But as I said, we are not waiting for it to happen. We want to be part of it. We want to be part of the development of this journey. And we are hoping that when they take off, which we believe they will, we will get the benefit of being at the forefront and being one of the innovators in this marketplace.
Another question which has been there in the market, you have given a release on Axis Max Life deal. You have yourself said that you are going to abide by it. But there were several reports saying that, regulator has concern. Is there anything from your side you would like to
We've just announced a deal. This newspaper or whatever the item which has appeared, I think relates to some of the discussions we had with the regulator more than a year back. There's nothing new. We have not gone to the regulator with the new application. Let it happen. Let us get us the permission. Then we can talk about it. So I think it is all speculation at this stage, and that's what I'd like to leave it at.
Back with the market right here in 80 now. The handover from the globe is weak, but the GIFT Nifty once again is indicating a flat start, and this after a good 100-point recovery that you had from the session low yesterday, scaling it back all the way to that 19,600 print. But let's shift focus to all the stocks and sectors which are going to be in focus, and let's look at a whole host of brokerage notes that Morgan Stanley has come out with. Harsh is here with all the details. Harsh?
Well, yes, as you correctly said, whole host of brokerage notes coming through. We're looking at, let me start off with ICICI Bank. They believe loan growth continues to remain strong. Margins are expected to moderate to through this year, through FY24, and they're expected to settle year-end FY24 where they were at year-end FY23. They're looking to accelerate on that branch expansion during FY24. Asset quality continues to remain benign, which is a positive, and within unsecured and MSME, where there has been a bit of concern, they are saying that the better rated customers continue to perform well, so there's comfort there. In terms of where Kotak sees it, loan growth demand across retail, SME continues to remain quite strong. You're looking at margins which are also expected to moderate. According to Kotak, you're expecting margins to be around that 5% mark for FY24. That's the guidance they've given. Asset quality remains benign, and operating cost will remain elevated given the higher growth momentum, is what Kotak has told Morgan Stanley. Bank of Baroda also loan growth quite strong, 14-15% loan growth. Margins expected to moderate. Asset quality benign. And no plans of capital raise despite CET1 at 12.5%. You're looking at the other smaller lender like an AU Small. They're suggesting loan growth of 25 to 30%. You're expecting better fee income trends, higher revenues in the credit card business to come through. Asset quality again benign. Credit costs around that 30 to 40 bips mark, and ROAs at 1.7 to 1.8%. Lastly, within the NBFC basket, we have Shriram Finance, AUM growth of around 15%, NIMs around 8.2 to 8.7%. You're expecting stable asset quality, and unsecured lending is being done to existing clients only. Largely, strong loan growth, moderating margins, as well as benign or solid asset quality is the theme of the note.
Okay, thanks very much for giving us those details. Let's move right on to the sidelines of the Global Fintech Fest, and lots of big voices emerging from there. My colleague Ankur Mishra caught up with Ashwini Kumar Tiwari, the MD of SBI, talking about credit costs and plans for YONO 2.0.
So credit growth continues to be strong. Now, it is not across all sectors. It is very strong in infrastructure, solar, now warehousing, logistics, personal loans, housing loans. These are areas which continue to be strong, education loans, auto loans. But there are also certain sectors where it is still not where we perhaps would like it to be. So my sense is that as the economy continues to improve, the left out sectors also will join the party at some stage. And therefore, to that extent, the GDP growth of 6 to 8%, which is the trend which is projected and also be seen, I think this should ensure that the credit growth continues to be strong. I mean, in India, if you have a credit growth between 13 to 14%, the general thumb rule is it should be double the GDP growth. So the GDP growth is about 7% or 14% credit growth is not an outlier. So in that sense, I don't think it's a problem. I mean, of course, there was some large pickup at the just post the COVID, which was.
Okay, that's some exclusive voices coming in to ET now on the sidelines of the Global Fintech Fest. One brokerage to the other, let's place our focus on IT bellwether TCS. That's going to be in focus on the back of the JP Morgan note. Let me take it across to Anisha. She skimmed through that note. Anisha, what are the details like?
Well, yeah, so JP Morgan has looked at the latest deal signings that TCS had announced last afternoon, wherein they have signed a deal of almost $8 million coming in with Jaguar Land Rover. And we have seen recently that a lot of these deal signings have happened within the company and the groups itself. Now, what JP Morgan is saying is it's a large deal coming in. They do not know the ramp up timeline, but the deal can add almost $200 million annually to the company's revenue. They are saying that if it does start ramping up in Q3 itself, the deal could potentially add almost 0.7% to the third quarter growth and 0.35% both to FY24 as well as 25. So that's the kind of ramp up they're expecting as far as this deal is concerned. It's a zero cost transformation deal, so they're not expecting a huge cut or impact on the margins, because usually large deals come with a bit of a blip on the margin initially, but they're not expecting that in this case. Recently, TCS has actually signed 3 large deals, and JP Morgan believes that these deals could add almost 1.8% to FY24 revenue, and almost FY25 revenue is also expected to scale up by a similar amount. The latest deal signings also included what happened with BSNL, as well as the $1 billion deal that they had signed up with Nest as well. Having said all of this, they are saying that this does not move the needle for TCS. What they are saying is that double digit is still very difficult growth to achieve in FY25, because the company needs large transformation and large digital deals actually to pan out, and there's also a bit of scarcity of those faster conversion cycles and orders, because they are the ones that help you to do the execution better and ramp up the revenue. Those are still missing as of now, and that's the reason they maintain the underweight stance with a target price of almost 2,700 thereabouts on TCS.
Okay, Anisha, we'll leave it at that. In fact, let's get back to the power sector as well. How can we not address that? We have with us Harshvardhan Dole, the Vice President at IFL Securities, joining into the show right now. Harshvardhan, hi, morning. Glad that you could take time out and speak with us. Just wanted to understand, how is it that you're analyzing what's going on within the power sector? Because on one hand, we at ET now are picking up from our sources that the power ministries actually asked the states and discoms to take immediate steps to meet the unprecedented power demand. And at the same time, the coal secretary told us just yesterday that the country has adequate coal stocks at all their thermal plants, at this juncture. So just wanted to understand, what is it that you're making of A, the power demand, which is clearly on an uptick, and B, whether we have enough reserves to actually meet that kind of surge?
Hi, good morning. So, firstly, on the demand side, clearly the erratic weather trends are pushing the power demand to unprecedented levels. What we saw is a bit of erratic weather can lead to almost a double-digit power demand on a month-on-month basis. And that's quite unheard in the Indian context. Possibly that is also being supplemented by strong recovery from the manufacturing and the other segments of the economy. What we have seen is on the supply side, over the last few years, there has not been addition in the thermal capacity, which is key for meeting base load as well as super peak load in the Indian context. To make things worse, we have 25 gigawatt of stranded power plants. So per se, the supply is quite tight and demand is quite robust. So essentially, you are coming to a very, very peculiar situation whereby India may actually end up facing power shortages. And to that extent, I think the move initiated by the Power Ministry seems to be quite pragmatic, that in order to avoid blackouts, they are cautioning the state utilities as well as the private utilities to be prepared for imports during the peak and super peak hours. It may not be necessary if actually Coal India is able to produce the required quantity of coal, but it is always better to be on the cautious side instead of facing a blackout, and particularly during the election year. So seems to be a cautious move, but very much well needed.
But in the near term, Harshvardhan, the merchant tariff prices will go higher. Which are the companies which have the maximum advantage because of this?
Very well said. The ACBs are actually seeing big amount of drawl from both the exchanges, and the prices are very well reflected of that. Unfortunately, Nikunj, if you were to analyze the sector over the last 10 to 15 years, the way it has panned out, the strict pure pay merchant plays are no longer existing. I mean, the good old names that were probably listed with a big bag listing a decade ago do not even exist. And to that extent, one might actually struggle to find great alpha plays or great merchant power plays in the sector as of now. But having said that, there are a couple of companies whereby you may find some open capacities, or there might be opportunities to restructure the old PPAs, which as of now are not remunerative, thereby seeing a massive upgrade to the earnings. For example, Tata Power. Tata Power has 4,000 megawatt of PPA with various states, and we all know that for last few years they have been trying to tweak that. They may actually see this an opportunity, as well as the states might see an opportune time to bury the hatchet and restructure the PPA. If that were to happen, you might see a massive upgrade in Tata Power, and that might turn out to be the best merchant power play given what the sectoral landscape is.
Okay. Do you think in the near term there is further scope for companies which have a high weightage on merchant power to get re-rated? Because if the merchant power tariffs and what you've spoken about and what our understanding is that the demand mismatch would be there at least for next couple of months, then it really could be party time for companies which have high exposure to merchant power.
The demand supply mismatch may last for a couple of years, not couple of months, in my opinion. And one should be prepared for paying higher power tariffs, particularly the guys who are in metros who are used to get 24/7 power. But that aside, I think people will try and work around ways to benefit from such acute demand supply mismatch. But instead of trying to find out those riskier plays, I will still focus on secular growth themes such as maybe NTPC or an NHPC, or at times slightly riskier names like Tata Power. There will be plays like maybe Torrent Power, whereby there is an outside chance that the stranded gas power plants may be operational, thereby leading to earnings upgrades. But those are strictly event driven, and one can't budget that into earnings as well as the PE multiples.
Okay, so a simple question for our viewers. For those who are convinced that look, power shortage is here, how do I maximize that in terms of making profits by buying stocks? Should one buy merchant power companies, which is utilities? I'm breaking it for our viewers. Should one look at power transmission companies because they also will have an advantage? Shouldn't one look at energy exchanges because there also the spread would increase higher? The entire cohort now will look attractive and interesting. What is the best way to maximize if somebody is looking at really converting this theme into a money-making idea?
Excellent question. I think there are multiple ways to play this whole power theme. Some people might want to play it in a less riskier route, which is by owning stable utilities like NTPC, Power Grid, CESC, Torrent Power, which get assured rate of return, and the earnings grow as the demand increases. But bear in mind, they don't have operating leverage. Some people want to play it through commodities, maybe through Coal India or Tata Power, whereby as the demand for coal goes up, their pricing power goes up, their demand goes up, and the earnings can accelerate. Dividend yields are fairly attractive. Then there is a cluster of investors who want to play slightly alpha names, whereby they don't want to own stable utilities, they don't want to take a commodity exposure either, and probably they are looking at some of the food chain companies, which is buying into smart meters or buying into power cables, or basically buying into the equipment manufacturers who will tend to cater to the capital, who will basically end up benefiting from the capex that these utilities would do. So there are multiple ways, and we at IIFL think that one should have a balanced approach. Bit of utilities, which is NTPC, Power Grid, and maybe Torrent Power, could be a good formidable combination, along with some of the food chain companies, which will emerge one of the biggest beneficiaries. And there are quite a few of them. Maybe Cummins could benefit. The order inflow could be very strong for companies like BHEL. Companies like REC, PFC will also end up benefiting because their loan book will keep on growing as the capex in the sector increases. So there are multiple ways. I think it's better to have a balanced portfolio when you're trying to play the power sector theme.
Harshvardhan, so glad that you could take time out and explain us and to our viewers what's really going on within the power sector and what's the best way that you as an investor can be making money here. Okay, let's move on. Let's discuss the markets and other sectors and stocks that are going to be in focus. Hemang Jani joins in on the show right now. Hemang, hi, morning. Good to have you on the show as always. Wanted to get your thoughts in as well on the power space and whether there's any stock that you think investors can buy at this juncture, be it power or ancillaries.
Yeah, good morning, Aisha. So power has become a big theme for past maybe 1 quarter or so. And I think for the right reasons, because while we have this demand supply mismatch because of the peak power demand, at the same time, because of the kind of capex that is witnessed across, we've seen order book growth for names like BHEL and some of the other ancillaries or equipment providers like Siemens, ABB, etc. And the typical, power manufacturing companies, NTPC, Tata Power, Adani Power, they are also seeing a bit of a re-rating because of the kind of growth and some sort of a stability on the tariff front. So I think there is a wide spectrum, and if I have to pick and choose something, I would go with the core power manufacturer, something like NTPC, where apart from the core business, you're seeing additional trigger coming in from the green energy and the new investments that the company has made. Also, exchange, IEX, we've seen recently in the update that there is about 30% kind of a growth. And though there was a bit of an issue in terms of new player coming in, I think the positioning of IEX is extremely strong. So I would go with some of these companies as an investment theme in the power sector.
That's the view coming in on power. And for a moment, let's deviate from that sector, although there's so much to talk about when it comes to power, and discuss QSR as a theme. Now, Nikunj, when it comes to the World Cup, people, of course, go crazy with ordering their snacks and pizzas. But data, according to the Macquarie report, shows that in the previous World Cups, 2011, 2019, it wasn't that much of a game changer because there's so many options now.
Well, there's so many options and options are increasing. But please remember, in the last 10 years, a lot has changed. A lot has changed in terms of affordability, in terms of appetite, how you consume content, what you eat, and how you order. So the variety in terms of variety, availability, and the optionality, I think is very, very high. Very simple. Urban consumption patterns are changing. And if you look at our personal consumption patterns, they're changing in terms of our dining out habits. So my limited point is, while Macquarie has come out with a report, which is there's a market perception that Jubilant FoodWorks and the QSR space would benefit, and they think that the risk-reward ratio is not that favorable, I feel that we could be in for a surprise. See, with consumer trends, you cannot pinpoint. When COVID happened, all of us thought it's going to be the death of luxury, it's going to be end of retail, we will never go to malls, everything would be online. It became a trend, but look at where do we stand right now. Rural has not recovered, and luxury numbers are absolutely out of the park. I feel that this theme would be a warm theme. Yes, the stocks have run up. That's what markets always do. You know, the run up sometimes is ahead of the event, and which is what has happened in this case. But I think even though the QSR valuations are slightly stretched, they're very stretched actually if you look at 1 year forward. But I think that this could be a warm theme. On every decline, on every bad day, if you go through a patch of decline, I think one should be looking at QSR stocks, and more than QSR stocks, you should be looking at pizza companies. Largely because of the fact that you can order in. Anything which benefits because of order in rather than going out and eating. I'm not going to be going to a restaurant and watching the World Cup final there. I might as well have my friends over and eat a pizza.
No, for sure, you will do that. But if you're going to order from McDonald's, if you're going to order from these brands, that remains to be seen. But yeah, you believe that?
I think the consumption patterns are changing. I never thought that SUV market in a country like India with a per capita income of $2,500 dollars will see a 55% domination. So I think we're in for a surprise. While valuations are stretched, but sometimes in the short term, when you have a trigger like this, expensive valuations may just extend themselves.
Okay, that's interesting. So Hemang, where is it that you're going to be ordering your food from this time when it comes to the World Cup? Would be interesting to find that out too.
Well, Avan, if I have to order, I would go with Subway salad and not with burgers and pizzas. But I think the theme definitely is very big, and we have to compare the global companies' market cap with what Indian companies are quoting at and what sort of growth they're delivering. So I think while we all will have our own, views in terms of stretch valuations, I think the fact of the matter is that the overall market cap in India for the names like Devyani, Jubilant, restaurant brands is far smaller compared to the global companies. And that would excite some people in terms of, investment themes.
Sure. Well, talking about the QSR slash FMCG space, yesterday the big buzzer was Tata Consumer, hands down. While, of course, the management clarified to the exchanges as well that they're not in talks of with Haldiram's for any stake buy. Haldiram's as well told us exclusively that they're not in talks with anyone for a sale of business. But time and again, these rumors do come up. Many a times in the past also we've seen that a particular party is interested in a stake buy in Haldiram's, but that deal never materializes. Having said that, Tata Consumer shot up nearly about 4% in trade yesterday. Today, of course, some of that move is going to get undone. But Kunal, on the charts, is it looking like a strong one inherently?
Yeah, I think it's looking quite strong. So the stock consolidating for, I think, the last 4 months from March or April end is where the stock got into this range of 820 plus minus 30-40 points for Tata Consumers, and then it's been just whiling its time consolidating into this band of 40 odd rupees for Tata Consumers. Yesterday was one of the first signs, volumes coming back, the prices making a comeback, closing about that 860 plus mark, which is also the breakout point for Tata Consumer. So in case if the stock dips down today, but if it holds on to that 860 levels, which is 20 points from yesterday's close, I would still consider that this breakout could be sustainable for Tata Consumers. And if that happens for the stock, then we could be looking at the next round of an upside, which is at least closer to 940 to 980 for Tata Consumers.
Hemang Jani, I don't know whether the deal will go through or not. Haldiram has denied, Tata Consumer has denied. Let's keep the deal aside. But Tata Consumer, irrespective of the deal, no deal, where is the stock headed? I mean, they're trying to do a lot. They've repaired the balance sheet. They're moving into categories which perhaps they have a leadership advantage. They're consolidating. But this entire proposition of a great Tata company, consumer brand, connect, return ratios improving, moving into makhanas and chips, it's available at a P of 70 times.
Yeah, so Nikunj, I think you will keep hearing about the deals. If you remember, Bisleri was also on the cards, and there were advanced negotiations, and finally I think the deal fell apart. Same thing we are hearing about Haldiram's. But I think, as you rightly put it, whether deal or no deal, the fact of the matter is that the way Tata Consumer has transformed over the last 5 years from a pure beverage company to a great consumer play with some of the marquee brands. And the fact is that there is not too much of dependency on the commodity prices. Earlier we used to have this issue of the tea prices go up and there would be some pressure, etc. But even the new business model and the product categories that they have entered into, I think there is a steady growth that one is witnessing. So I think valuation wise, it is looking a bit stretched. But I think it's delivering in terms of earnings. And for somebody who wants to hold, let's say, as a core portfolio, I think this is a great stock to have.
Okay, I'm going to shift gears and go back to banking. Why is banking underperforming? How long will the banks underperform? Have they corrected enough? The RSI indicators are not looking stretched. IT has made a comeback. Could it go back to banks? And that is something I think is worth discussing again and again, Nuresh, that at what point in time it's time to revisit banks?
So currently the time is to visit banks, because what we are seeing is a consolidation across the board. So if you look at ICICI Bank, around the same price, you have HDFC Bank around the same price, you have Axis Bank around the same price for the last almost 2 weeks to 6 weeks. Technically waiting for price action to confirm a move above 1000 on Axis Bank, 1620 on HDFC Bank, and say 980 above ICICI Bank. Once that happens, that gives a clear indication that the momentum has shifted on the upside. As of now, they are not falling, they are not rallying, they are at the same price. They've not, and banks as a sector does not have a tendency to remain at the same place for months together. It's not a defensive sector per se. So watching out closely, because the contraction has gone too far across the banking space. At the same time, small cap banking names have done well. So you look at IDFC First Bank continues to do well. Even RBL Bank has done well. You have something like a Federal Bank at an all-time high. So overall, the broader market banks have done better. The large cap banks have done nothing, but look very, very interesting.
Himangjani, is it just transitory what's happening to banks, and is it just momentary what's happening to IT, which is that eventually at the year end, IT will be a weak sector and banks will be a strong sector? Right now it's reverse. I mean, reversals can happen. But ultimately, do you think one should go back to banks and get rid of IT?
I think, Nikunj, when it comes to banks, there is an underperformance because of 3 reasons. One is that the NIMs, there was pressure, particularly for some banks. There's an over ownership, banking, the weightage and the way people have gone about, buying banks in the last, let's say 1.5 year because of the performance. I think that sometimes has, some sort of a bearing in terms of performance. And I think there is also a sense that having seen a 14-15% kind of a loan growth, maybe there could be a bit of a, period of a little bit of a slowdown over there. But I do not think there is a case for any significant correction in the banks, given the overall positioning, valuations, growth visibility, etc. So I would surely look out for buying into some of these names, be it State Bank of India, or for that matter, HDFC Bank, which has underperformed and now is showing initial indications of some sort of a up move. ICICI Bank, I think it's time to kind of accumulate banks at this price point.
Hemang, it clearly seems like now people are really right back to enjoying their lives with a vengeance, be it the kind of advanced bookings that you're seeing for Gadar 2 or even Jawan right now. The fact that for the ICC Men's World Cup, things are really getting booked out. People are ready to shell out phenomenal rates for hotels and even airfares. What exactly is this indicative of? And from a stock market perspective, what is it that you would look to bank on for the long haul? Or do you think that this is just sort of a momentum move?
So I think when it comes to the media and the movies, I think we've seen slew of good releases, whether it is Gadar 2 or 2-3 other big movies which really did well, and that has brought the interest back into the PVR kind of themes. And I think maybe it could be a tactical play, because it all depends upon how long this content theme will last, how long we will have the blockbuster releases. So look at it from a tactical point of view. But I think if I have to play a structural story, I would go with something like a Indigo or the hotel play, because that is where you're seeing a much better growth with much comfortable margins. And I think in terms of growth, Indigo can actually surprise us with the kind of international forays that they've done over the last, let's say, 1.5 year. So I think both hotels and aviation could be interesting themes to look at now that we are approaching, Diwali holidays and the kind of action which is there in terms of the hotel, ARRs, etc. So these are the two themes that I would go with.
Yesterday, Lux Industries, it is in innerwear segment, breakout. Page Industries above the 200 DMA. Just a coincidence, trust me, nothing else. Lux Industries, look at the stock volume just exploded, 1586. We don't talk about it, but Lux, Rupa, some of these stocks have done exceedingly well. And then Page has come back actually. Page has come back. Nuresh, this was like the real darling. Every day, all you have to do just keep your faith, buy Page Industries, and between 2015 and 2020 or 2012 and 2018, you hit a multi-bagger on your hand. Then it moved into hibernation. Then it went below the 200 DMA. But now it is at 40,000 again, Nuresh.
Yeah, so it went through a phase. It topped out around 36,000 in 2018, and we are at 40,000 odd today. So it went through that phase, and now the phase has again continued in terms of the correction from 54,500 went to 36,500. Purely on a technical basis, the stock made a bottom around 36,500 in March, again in May on quarterly numbers, again in July around that number. So there have been 3 bottoms around that area. On the upside, the big gap down was around 41,500 to 42,000, which was the top in August. So we are getting back to that level. So a breakout above that actually gives us a target price of 43,500 to 44,000. So purely from a technical perspective, yes, it's a short-term breakout, which could take it higher. One would have a strict stop loss at 40,000 here. The other names at the same time, the problem is you look at a Lux Industries, the stock moves up in a single day with very large volumes, but the delivery volumes are pretty low. So yesterday the delivery volumes were not great. That's the problem with a lot of these stocks. So if I were to look at Lux delivery volumes, yesterday was just 10% of the marking was delivery. So that's the problem. A lot of speculation which happens on a single day in Lux, Rupa, dollar together. So out here, I'll be a little careful because a price uptick actually requires a higher delivery volumes also to confirm. So a single digit or 10-15% delivery volumes indicates there was a lot of intraday speculation. So I would be looking out only for Page Industries as of now, or maybe a better chart out of the 3 is dollar industries. So overall, it's a sectoral short-term breakout. We've seen all textiles do better one by one. Now we are getting into the garmenting side of it. So out here, looking at Page Industries, but with a strict stop loss at 40,000.
There is another sector that you can talk a lot about apart from hotels and hospitality, Naresh. But that aside, wanted to get in your views then, Hemang, when it comes to stocks like ABB. Although it has been a phenomenal run, some experts and analysts are of the view that there are a lot of speed bumps ahead. Within this entire theme, where is it that you find comfort?
I think we've seen a massive re-rating for names like ABB, Siemens, and entire cap goods space. And the good part about some of these MNC companies, you can also include Cummins into it, is that the equity base of the floating stock is much lower, and we've seen a very significant improvement in the order inflows. So I think this may continue. I think Siemens recently also bagged a very big order, and it's not confined to one sector. It's well spread, whether it's railways, the overall industrial capex, and whole host of things. So I think that may continue for a while. If I have to pick and choose, I would go with something like a BHEL at this point of time, and to some extent Siemens because of the kind of order inflow that it has seen. I think there is a scope for some more up move, maybe around 5 to 10% over there.
Were you nodding your head, Kunal, when Hemang said BHEL?
Of course, absolutely. I have to nod for BHEL.
So what's the view on the charts from some of these names?
So bullish on BHEL. I've been bullish on the stock since it was two digits around the 80 odd mark, 86 odd mark. So would continue to be bullish on the stock. And my expectation is that this is a very strong breakout for this PSU name, because the stock was a huge underperformer in terms of time, in terms of the timing of the stock with respect to the other peers, as well as the most of the stocks in the PSU baskets. So I would be quite keen into going bullish on the stock. It's just that I think 2 days back, or a couple of days back, the indicators had come back into an a slight overbought territory for BHEL. So what you're seeing right now could probably be a cool off, which may last for another 2-3% for the stock price. But I think closer to 130 odd levels could be a good contra-buying territory for BHEL.
Okay, pre-open rates then on your screen, and given the fact that yesterday it was a smart move, this morning we've woken up to pretty somber cues from across the globe. So perhaps taking that into cognizance, it's not a bad start actually on the Nifty, but for the Sensex pretty much down in trade. But these of course are just the pre-open ticks. Let's find out what those mid-cap calls are as well. What is it that our chartists are picking out for the day, Kunal?
So from the sugar pack, I'm picking up Andhra Sugar. That's a stock which I think at 120 plus levels has given a swing breakout in the charts, trading above the 200 DMA, or rather has broken past above the 200 DMA just about a couple of days back. Looks attractive, and I sense the entire sector also looks attractive in terms of a short-term momentum. So buy on Andhra Sugar, 133 as a target, stop us at 121.
All right, let's find out, Naresh, what is it that you're picking out from the mid-cap corner?
So that would be a buy on LIC of India with a stop loss at 660 and a target price of 760. The stock saw a price action today wherein it broke out the last 3-month highs. And the volumes were the highest in the last 6 months. So looks like a short-term triangle breakout. The stock was in a tight range of 650 to 675 for the last almost 1 month. So looks like a trend change here could go towards the previous highs of 2022 closer to 760 in the short term.
Okay, let's get a move on and let's tell you what else is happening outside the world of equity markets. And in his opening remark at the ASEAN Summit, Prime Minister Narendra Modi stressed on the significance of the region in India's Indo-Pacific initiative, saying that ASEAN was the center point of India's Act Easy policy. The PM is in Indonesia, remember, to attend the ASEAN, India and the East Asia summits, during which he will discuss the future contours of India's partnership with the countries in the strategically important region. Also ahead of special session of Parliament, Congress MP Sonia Gandhi has written to PM Modi claiming that the meeting was called without any prior discussion with the opposition. On the other hand, the BJP accused Congress of trying to politicize the functioning of the Parliament and create unnecessary controversy. Also, cricket enthusiasts from around the world can now secure their seats to witness the biggest cricketing event of the year. The BCCI has announced that it will release 4 lakh tickets in the next phase. The general sale of the tickets for all matches will take place from 8 p.m. onwards on September 8th. That's tomorrow.
Meantime, while the third seed, Daniil Medvedev has beat both the brutal heat and a gritty Andrei Rublev to fight his way onto the US Open semis. Right now, all eyes on Alcaraz and Alexander Zverev, who are fighting to get a place in the semi-finals, with Alcaraz, of course, currently leading the race. And for moviegoers, the wait is finally over. Shah Rukh Khan's action flick Jawan has hit theatres. The actor's fans are very excited to watch their favourite star on the big screen. The excitement around the launch is much evident from the advanced ticket numbers as well, which have sold a record 4 lakh tickets at national cinema chains.
Okay, and as we get set for the market open this Thursday, Ashiana Housing, that's one company which is going to be in focus, and it's expected to launch 4 new towers in Gurugram in the month of January. What else is keeping this stock abuzz? Let me take it across to Sharad and get in all the khabar. Sharad?
Well, yes, in focus we are having Ashiana Housing, and the buzz in the street is that new towers are expected to be launched in the new Gurugram area in the month of January. Roughly 4 towers are expected to be launched, and almost you could say 225 units would be there, which would be of the 3 BHK size. Now, the most important thing is that the 25% expected increase is expected for the pricing since the last phase, and the booking value is estimated to come around 320 crore rupees. Recently, the company did sign an agreement to develop 11 lakh square feet of area with Saraf granite and marbles. And looking at the key triggers going ahead, the company has stated they are expecting a pre-sales of roughly 1500 crore rupees in the current year, and also there will be a ramp up coming in the senior living projects in the cities of Chennai and Pune. And lastly, the company did mention that they do not see favorable margins coming in, especially for the Noida market currently.
All right, let's move right on then. And find out what is on the editor's radar today. QSR stocks in focus. Remember, ICC World Cup is around the corner. So what's Nikunj's take? Listen in.
Well, there are so many options and options are increasing. But please remember, in last 10 years, a lot has changed. A lot has changed in terms of affordability, in terms of appetite, how you consume content, what you eat, and how you order. So the variety in terms of variety, availability, and the optionality, I think is very, very high. Very simple. Urban consumption patterns are changing. And if you look at our personal consumption patterns, they're changing in terms of our dining out habits. So my limited point is, while Macquarie has come out with a report, which is there's a market perception that Jubilant FoodWorks and the QSR space would benefit, and they think that the risk-reward ratio is not that favorable. I feel that we could be in for a surprise. See, with consumer trends, you cannot pinpoint. When COVID happened, all of us thought it's going to be the death of luxury. It's going to be end of retail. We will never go to malls. Everything would be online. It became a trend, but look at where do we stand right now. Rural has not recovered, and luxury numbers are absolutely out of the park. I feel that this theme would be a warm theme. Yes, the stocks have run up. That's what markets always do. The run up sometimes is ahead of the event, and which is what has happened in this case. But I think even though the QSR valuations are slightly stretched, they're very stretched actually if you look at 1 year forward. But I think that this could be a warm theme. On every decline, on every bad day, if you go through a patch of decline, I think one should be looking at QSR stocks, and more than QSR stocks, you should be looking at pizza companies. Largely because of the fact that you can order in. Anything which benefits because of order in rather than going out and eating. I'm not going to be going to a restaurant and watching the World Cup final there. I might as well have my friends over and eat a pizza.
No, for sure, you will do that. But if you're going to order from McDonald's, if you're going to order from these brands, that remains to be seen. But yeah. You believe
I think the consumption patterns are changing. I never thought that SUV market in a country like India with a per capita income of $2,500 dollars will see a 55% domination. So I think we're in for a surprise. While valuations are stretched, but sometimes in the short term, when you have a trigger like this, expensive valuations may just extend themselves.
Hemang, what's your take on the kind of moves and news that we've been seeing within the pharma space? Lots of report and conjecture with respect to the Cipla buyout. How are you reading into that news, and what's your outlook on pharma in general?
So the large cap, generic companies have really remained quite resilient, though there was a bit of a consolidation phase. So I think within the large cap names, Cipla definitely would be on the top of the radar because of the additional trigger of the promoter, stake. Apart from that, I think Dr. Reddy's is something which has really surprised in terms of the performance and the way the stock has really bounced back. I think that would be a top name when it comes to the generic space. I think within the mid-cap space, you have a whole host of companies, Laurus Labs and many more. So I think we can choose which one to go with, but I would really go with the large cap names, maybe something like a Cipla and Dr. Reddy's.
Hemang, always good to have you on the show. Thanks as always for taking the time out.
Thank you.
Okay, let's move on. Let's discuss some of the other buzzers in trade. And TCS definitely is one stock that you may want to keep on your radar. There's a brokerage note coming in on the IT sector as well. But that aside, there's TCS, which has also got that order from a JLR. So look out for what that stock does. Of course, it's a group company, but an £800 million order is what they've bagged from JLR for the next 5 years. There's ONGC as well. Crude continues to rise on hopes of supply cut. Brent now is, remember, at $91 to a barrel. So ONGC makes a move of about almost 1% or so. Biocon, they've completed the integration of Vitris biosimilar business in the North America region. So that's another stock which has started off with a gain of about 1%. There's Lupin as well, which has collaborated with Mark Cuban, Cost Plus Drug Company and COPD Foundation as well. So sentiment positive, 0.5% higher there. And then REC, which has signed a $100 million foreign currency term loan agreement with Exim Bank. That's going to be the other stock which is going to be in focus this morning. Besides that, of course, we're looking out for what the IT pack is going to be doing. There is a brokerage note coming in from Nomura on the IT pack. Macquarie on HDFC Bank, they maintain the outperform rating with a target price of 21.10. So that's the other stock which we're focusing in on this morning. Goldman Sachs, a buy with a target price of 2600 on Interglobe Aviation. These are a couple of stocks which are on our radar this morning. But Kunal, just wanted to understand the disconnect between what the large cap universe is doing and in specific what small caps are doing. And do you think small caps will continue to move up?
So small caps can continue to move up, but then most of the stocks are actually coming back to the overbought territory. So there would be some sort of an aberration in terms of price correction for the small cap names. That could be part and parcel in terms of the structural trend for many of the stocks. Like for example, many of the sectors and stocks have underperformed. So if these stocks get into a leg up move, you could probably be seeing this as a trend shaping up. So in a trend, every time the stock gets into an overbought territory, there's a cool off, price correction, slight consolidation, and then the stock tends to move up. But even the large cap stocks would probably not be left far behind, because I would sense that we are now getting into that round of short covering for large cap names. It's very subtle, very light in terms of the short covering data for many of the large cap names, but it started to happen for the large cap stocks. We would just need maybe a couple of days of follow through of this data. If we see that happening for say the likes of HDFC Bank and ICICI Bank, etc., Reliance, Bharti Airtel, then I would probably expect that this move would trickle into the other underperforming large cap names. So I sense that the move seems to have started, but maybe a couple of days of more confirmation can probably give a strong indication that the large caps may make a strong comeback.
Okay, let's also understand the index strategies as well this morning. Let's start off with what the call on the Nifty is this morning. And it's pretty much a consensus all across the board, much unlike yesterday where only Kunal had the conviction of going out there and buying the Nifty. So hold coming in from Kunal, from Naresh Mirani, from Kush Bora as well. So consensus there on the Moodometer with a hold on the Nifty. What about the Nifty Bank? And again a consensus there as well from Kunal, Naresh as well as Kush. So pretty much a consensus on the Moodometer, which is indicating a hold right now for the Nifty Bank as well.
Naresh, we are not far away from what could be called as that key congestion area, 19,600, 19,700. Why wouldn't you preempt the breakout? Because if banks, if you think, are likely to chip in, IT is stable, railway stocks are holding on, defense stocks are holding on. So why not preempt the breakout?
So actually preempted the move when we discussed last Friday when there was MSCI sell and expiry, etc. Thursday, Friday when we were dipping at 19,300. That's the time. Took a long position there. They have been on buy mode in those 2 days. Since then, it is just riding onto that position. Once we sustain about 19,600 and once I see some heavyweights actually breaking out, that is the point of time you'll be comfortable buying it even 19,700 and not at 19,500, 600. So as of now, not seeing a strong move in any of the heavyweights. So we need some of the constituents to break out. Once that happens, the congestion is such that we should have a 500, 700 pointer move. So would be better off leaving off 100 points on the table and adding more on the way up at a confirmation of price action and breakout across the heavyweight space.
Okay. Kunal, the same question for you. Why not preempt?
So was in the buy mode yesterday and in the last 2 days specifically. So would maintain that whole stance on the index purely because my sense is that we should. So I've seen this phenomena at least in the last many trends that whenever the Nifty has managed to come back below the 50 DMA and in the next couple of days or in the span of the next 1 week, if it comes back above the 50-day moving average, we've seen that the index has a capacity of breaking past above the previous high in many of the trends. So 2018, 2021. And then prior to that as well, we've seen many instances where the index has managed to do it. So I would probably go with the flow this time around and expect that we would probably get back into the line of outperformance. The only thing which is, adding to that a bit of probability is large cap stocks just starting to show a comeback. If that comeback sign is more decisive, then we can be more, we can probably ascertain a higher probability that we could probably cross back about the previous size of 9,900.
Okay, now a minute to go, not too many newsmakers. What do you want to revisit? You want to revisit Tata Consumer? You want to look at Keynes? You want to look at Sharma SGX? You want to look at, to some extent, Amber and Dixon? That's one space where the price action has been incredible, and there is a CLSA feels thereby. I think Kodak's come out with a downgrade, so more like a mixed picture there. And JP Morgan's come out with a very clear view that the tide for large cap IT has turned. So let's look at some of those stocks here, please. We are still with the recent close, doesn't matter. I'll just get updated. Keynes, Amber, those are the names you want to look at. You want to definitely look at first rates. We'll revisit those stocks when the rates actually start. 10 seconds to go in the first rates, any second now. It's going to be a flat start with a downward bias. Bias doesn't matter. 30 points here on the Nifty. Here or there really frankly does not matter. What do you want to look at? Tata Consumer, because of the denial, and it's like a clear denial, explicit. They've explicitly denied that, look, they're just not talking to Haldiram in terms of any kind of a deal arrangement or any kind of a stake buyout. First rates, Nifty, 16 points down. The breadth of the market, I won't say it's near perfect, but the breadth of the market is looking promising enough. Tata Motors, ITC, HDFC Life and Axis Bank, these are some of the stocks which in a sense are moving on very, very smartly. You want to look at some of the EMS companies, electronic manufacturing stocks, so that includes a name like Keynes, Amber, Sharma. This entire space has been on the cartwheels, so to speak. Tata Consumer denial comes in. Why the stock went up, I don't know. But now I guess it is coming back to where it was yesterday. Brokerage impact, Dixon, TCS and HDFC Bank, that's there in terms of the impact per se. All the railway stocks one by one. Let's look at all the railway stocks one by one. Sharma, Keynes is up 7%. Wow. Sharma is up 2%. Keynes was at 1,000 rupees at the beginning of the year, and not even a year has ended. It's become from 1,000 of 800 to about 2,000. That's the power of liquidity, which can really surprise you. The issue was not great, but post that, the stock has just gone absolutely out of the park. You also want to revisit some of the pharma names, especially Glenmark Life and Loris, all kind of buzz and deals. Rumor is there, and then Indiabulls Housing Finance along with BHEL, where the price action and solid volume action yesterday was. Aisha?
Yeah. Let's also check in on what Tata Consumer is up to, because while it did gain 4% yesterday, right now it's down nearly 2% after that vehement denial coming in from the management that they're not looking at any stake buy with regards to Haldiram's. Tata Consumer now down 2.6%. And I think it's going to pretty much undo all of its yesterday's gains. Infosys, Nomura has upgraded it to a neutral from the earlier reduced. They've hiked their target price also to 1,410. So look out for what this stock does. There's Axis Capital, which has downgraded Concord now to an add from the earlier buy. So look out for what this stock as well is doing in trade. And then TCS has also bagged orders worth about £800 million, remember, from JLR for 5 years. ONGC, crude continues to rise on hopes of a supply card. Brent is now at 91, ONGC marginally higher as we speak. Let's check in on some of the other names and let's see what Paytm is up to. They're looking to scrap the plans to enter the insurance business. That's what sources seem to be indicating to us. Paytm down by about almost 0.5% as we speak right now. There's Biocon, which has completed the integration of Vitris, biosimilar business in North America. That stock holds up 0.5% or so. Shriram Finance, small cap world fund, had sold 47 lakh shares yesterday in a block worth about 880 crore rupees. Right now too, it's a little bit soft for Shriram Finance as we speak right now. But yep, that's pretty much it. Not a whole lot by way of newsmakers. I also want to check in on what Idea, Indus Towers are up to. Remember, these were big buzzers in trade yesterday. Idea shot up 7.5%. Right now also 0.5% higher as we speak. And Petronet LNG was the other one which held out very smartly yesterday. So let's see whether there's any follow-through coming in there. It's softened down a little bit, Petronet LNG, 0.2% lower as we speak right now. Kunal, what are the first trades that you're punching in?
So HDFC Bank is something which I would probably bet on, expecting that if the stock just carries forward yesterday's momentum about the 1600 mark on futures, we could be expecting another round of short covering. So that's a stock which would be looked to buy at the opening.
All right, Naresh, what's your take on the market open this morning? Holding on to the 19,570 mark in trade. It's yet again the broader markets looking like they're taking leadership. What's your first trade?
So same again, we are still stuck in the band. The stock I would be looking out for is LIC of India at around 680, 675. Looks like a stock which could break out in the